Earnings, they kicked off this morning. Disappointing results from J.P. Morgan and Morgan Stanley. So we have new lows today, guys, for Citi, Bank of America, J.P. Morgan, Goldman, and the aforementioned Morgan Stanley. Weiss, you're short currently the XLF?
Yep, and when we had discussion last week, you said, well, why are you short? And I said, because I still have gains in Goldman and B of A, but I think the bank's going to miss. Again, it was obviously apparent, just watch the market, with the highest margin business being corporate issuance, being down to virtually zero. So I took out a position in shorting the XLF, which hedged my downside. So I'm basically neutral on the position, and it's working out. I'm going to stay short the XLF and stay hedged on it for a little while to come yet, because I just don't think it's going to get better, and we're not through bank earnings yet.
You have a good amount of exposure here, Jim. JPM, Citi, Goldman?
Yeah.
Concerned?
No. Okay. And I know I'm looking at you. I know you're going to say I'm only seeing the good of it. I promise you. Listen, Scott, I've been punched in the face every day this year. OK, I've got the negative. I promise you, I've got the negative. I see it. All right. I just don't think the positives are being seen. All right. Loan growth demand picking up. Right. 7% year over year. Look at it. You can't see it on the show. He's smiling. He's waiting for his comeback. Let me finish first. All right.
I'm just trying to think if there's anything out there that you feel negative about.
Dude, I've been punched in the face every day this year. I feel it. I got it. I don't wallow in it. All right. I look at what they're saying.
I'm not.
Net interest income. Hang on. Net interest income for this year. Now, we're in a good mood. We're having fun. Okay.
Well, it's all good.
Net interest income for this year, they guided up from $53 billion to $56 billion. Why, like, the business is good.
Yeah. It's good now.
Oh, God. Okay. Yep.
The business is great. The business is great. Everything's great. The sky's blue. Sun's out. Stars will be out later. Stocks at a 52-week low. Stocks at 52-week low.
A lot of stocks are at a 52-week low. So what?
It's double the loss of the market. It's down 38% from its high.
Yeah, and what's its 2-year and 5-year?
Yeah, exactly.
Oh my God.
Well, this is
oh my gosh,
what's the
right
S&P
back
up
to
for
you.
the last 10 years?
But this is where
oh
we
my
get
God,
back
what are you trying to make this out to be Zoom? It's not.
I didn't say it was Zoom. But I mean, you just painted a picture that everything's great with the banks. I'm just telling you, the stock's at 52 is at a new low.
You are factually correct. Okay, I'm taking your facts. I'm taking all the facts. I'm analyzing them. I'm drawing a conclusion. You disagree with the conclusion? That's fine.
But this is where you need to say, do I buy it here and now today? And okay, yeah,
what's
it's down
answer?
40%. Well,
107 for JP Morgan, $107.11.
For Jim, the answer is you buy it here and now today. And this goes back to some of the conversation about, like, do you try to make it back in what you lost it in, right? Do you only hold something because you think it's going to get back up there? I always tell people, no, start fresh today. And so you start fresh today, like, erase the fact that it's down 40%. Start fresh today. Where might it go from here? What do you think about the economy? If Jim is not as negative as some of the rest of us are on a recession, and he understands the balance sheets of these companies and understands the valuations, then maybe from this point today, you've got 15, 10, 20% upside. That's pretty good.
Okay, let's ask Josh. He owns JP Morgan, too, since we're centering on that one.
Yeah, JP Morgan is planning an advance for what is pretty obvious coming soon to a theater near you, which is delinquencies in auto loans, credit cards, foreclosures eventually, probably a lot of debts going bad. So, but the banks are not, I think, susceptible like it's a systemic issue. They have a lot of capital. No. They are very well reserved for this. They've been extremely conservative. They've been regulated like utilities for most of the last 12 years. Whether they liked it or not, it's actually now helping them a great deal. And what you saw J.P. Morgan do was basically get itself in alignment with where it needs its Tier 1 capital to be. And that's a formula. It's like it's not their choice. So they have to be at a certain place over a certain period of time in terms of how much risk they're taking relative to how much equity they have on the line. So I don't know if it's like prophetic. I just think it's like this is what a large money center bank that is a SIFI, a systemically important financial institution, has no choice but to do. The good news is that process is happening, and I don't think you should look at the banks that are already down 33% and say, oh, no, there might be risk here. you've already paid the price for that if you've been a shareholder in all of these names. The regionals are way worse, right? The silver lining, though, if you're making a new investment today in Citi, in JP Morgan, the silver lining is a lot of these nonsense fintech companies that have come along and stood themselves up by saying, look how cool our app is, they're in much worse trouble. They're going to have a huge uptick in the cost of funding. They have all this crypto stuff on their balance sheets. They have very inexperienced people, for the most part, who have not been through a financial crisis, and they will stop making loans. And you can see that reflected in the average fintech share price, publicly traded, just absolutely in wipeout, down 70, 80%, and that's the ones that'll make it. So if you're making an investment in a large money center bank today, you can feel confident that they will keep lending through whatever is to come, and they'll keep lending afterward, and they're not going to lose, they're not going to lose their business during the course of that lending because of new regulations that they now have to abide by. So I think Jim's going to end up being right on these names, but from today's prices. But I also think it's going to take a while, and you could be in for some more pain before you get that benefit from taking a bite. So you have to, if you're an investor, you have to live with that.
Right.
That's
I mean,
the
look,
reality.
I think Mike Mayo set the table well for us in overtime the other day. He suggested, as bullish as he is on the long-term picture of the banks, and I think Jim's making that case too, although, maybe he's a little more closer in positive.
Dude, Mike Mayo,
others.
but hold on. Mike Mayo is reverse green eggs and ham. Like Sam I Am wouldn't like them in a box or with a Mike Mayo will be bullish the banks pretty much through anything at any price. So what I'm saying.
Yeah, I know what you were saying.
Come on,
I was
that was a
serious.
really good one.
I know what you were saying.
I love Mike.
I know, and
Okay.
I was trying to go to break there, but thank you for wrapping that up for us.
Sorry.
Appreciate it.